Now, you're probably tired of hearing that the Mag 7 are the only stocks that are keeping the stock market up. Well, it's not really the Mag 7, but tech in general. And yes, if you remove the Mag 7 from the S&P 500, or tech in general, sorry, from the S&P 500, we are actually at historic lows. So this piece on Bloomberg just came out showing that the stock market, the S&P 500 more specifically, is actually at historic lows if you remove tech. So what does this mean for the stock market? Is this good or bad? Because this can be interpreted really in each direction. And I'm here to provide you more nuance based on analysis. Now, I do think in summary, I'm just going to tell you right now, I do think that things are starting to look concerning. And I will tell you why that is. And you know that this channel, I'm not a permabear. I'm actually one of the few people that told you that gave you my investment thesis when I'm investing, told you that I was buying the SPY at 410, which happens to be the exact level that the SPY hit at the bottom of the correction. And I told you when we were in a bear market that I was actually doing some buying as well. So I'm not a perma bear. Matter of fact, if you take a look at my Twitter, and I post daily trading and finance content on both my Twitter and my Instagram. So make sure you're following me on there because I post a lot of beneficial stuff for free all day. But I posted my buy here on the S&P 500 was at 365.92 for this account, my swing account. And if you look at 365.92, that was right around the time of September, October of 2022. But as I've told you time and time again, I do believe that a recession is close. And as I've told you, as it relates to the stock market, it would not be weird that we get a recession at all-time highs. As a matter of fact, recessions often occur in bear markets, but recessions often occur near all-time highs. You see this back here in 2020. If you go all the way back to 2008, when that recession started, it actually officially started in December 2007, and in October 2007 is when we hit all-time highs. So hitting a recession or hitting an all-time high before a recession is actually a feature. And obviously, who can leave out the narrative of the Fed? The fact that the Fed hiked rates faster than at any point in time. And as I've said before in this channel, all-time highs with peak rates is not a good recipe. So in this video, I want to talk more about that Bloomberg metric that showed that we were actually at historic lows if you remove tech from the equation. Does that mean that other stocks are going to rally now? Does that mean that the market, because it is only held up by the Mag 7, that it is going to come crashing down? I'm going to give you that answer in this video, and I'm going to tell you what factors I think will lead to a recession. Obviously, not only do we have the inverted yield curve, not only do we have the fact that the Fed is at peak rates, but what is going to make the Fed actually cut? Hint, hint, it really has to do with commercial real estate. So I will get into that and let's go. So as you see here, the S&P 500 is at historic lows. The last time we were at this low was in 1999. Now, this is the S&P 500 minus tech. Obviously, tech was even more inflated, in my opinion, in 1999 than now, because the tech companies of now are actually the most profitable companies on planet Earth. Believe me, I was alive in 1999 as an adult. Yes, I'm old as hell. A lot of these tech companies, most of them were not profitable. They were not turning a profit. They didn't even have a semblance of the revenue that the tech companies of today have. So it is not exactly the same. However, if you look at the dates here, 1999 is when we hit that low minus the tech companies. Then what actually happened as we got to the year 2000? As we got to the year 2000, you see that this metric actually rose, meaning that the rest of the S&P 500, the rest of the market actually rose with it. And this is what I was saying about a potential rotation before a recession, because we got a rally and directly thereafter, we got a stock market crash and a recession. And I'll show that to you right here. If we look at the monthly chart for the S&P 500 and we take a look at that period in 1999, the S&P 500 in 99 actually rose 20% thereabouts between in all of 1999 before we actually crashed. Actually, it's a little bit more, almost 25% that the S&P 500 rallied in 1999 before August 2000, which was the all-time high in the stock market before we actually had a crash. And this is what I think is probably the likeliest scenario here. I've said before on this channel, if you guys are fans of this channel, that I do think there are some sectors in the market, such as small caps. I do think that there are certain stocks, in addition to some of the S&P 500 sectors. Like if we take a look at utilities, for instance, you could see that there is still quite a bit left for it to get to its all-time high. Utilities is one of the most beat up sectors in the S&P 500. If we take a look at consumer staples, you could see a very similar situation. If you take a look at energy was doing well, kind of got beat up. It still has quite a bit of juice left. So you have energy, consumer staples, utilities, healthcare, and tech are really the only two sectors that have been actually killing it for the S&P 500. So there is quite a bit of juice left in this market. And for me, I really think if I was to take an educated guess and put my money on the line, I really think that it's just a race between the stock market and the sectors that have yet to be rotated into. And when things start to break in the economy, that would worry the Fed enough to start cutting. And by things starting to break in the economy, I'm referring to mostly commercial real estate. Now, nobody has predicted a black swan to the T. There are usually a lot of factors that go into this. So I want to talk about this and give it the respect that it requires. But I just want to talk about the markets just a little bit more and what can happen before a recession. So right now, as I said, I think it's a race between, the market is going to be a race between stocks that have yet to be rotated into and those actually lifting, right? Like sort of a rising tide lifts all boats, right? And the economy actually taking a hit, causing all of this to stop before we finally get some sort of correction and or bear market. So as we see in this game of chicken, because we've had such strong economic data, now the chances that the Fed actually cuts in March are very slim. This was up to 77% just a month ago, and we are now down to 13% chance that the Fed is going to cut because the economic data is so strong. So the longer that they have to keep rates up, the higher the chances of a tail risk, right? The higher the chances of something really breaking in the economy, causing a recession, forcing the Fed's hand, which is what usually happens. This is why we've never seen a soft landing, ever. We've only seen hard landings because, raising rates is such a blunt tool that the effects of it just come crashing down before you even have time to react. So even if we take a look at May, sorry, my head was in the way. You can see here 43% chance that the Fed doesn't cut. And just a month ago, this was at 0. So because of the strong jobs data, because of the strong employment data, because of the fact that inflation by the measures that they use, PPI, CPI, etc., PCE, is coming down, forcing the Fed to not be able to act and cut rates as soon as they would like, right? And the longer that they keep rates up there, the higher the chance that something is going to break. But again, it's so hard to predict that timing that I think the market can keep inching up for another few months until that happens. Just like we saw if you look at this chart here, just like we saw back in 1999, right? Right before the recession in 2000, the rest of the market continued to rally until we got to 2000, hit an all-time high, and that is when the recession started, right? I think something very similar is going to happen here, where the market can continue inching up for another few months until something breaks, the Fed has to cut, and that is when we will get a correction and even maybe a bear market, maybe even a recession, right? So what is that thing that might happen here? Well, I believe that the situation going on in the commercial real estate market cannot be ignored. You are starting to hear this now from Janet Yellen. You're starting to hear this from Jamie Dimon. And once they tell you, I have to assume that it's already too late. Like the markers were already there. And now they are coming out and letting the cat out of the bag, right? And just a couple of weeks ago, New York Community Bancorp, which is another regional bank in New York, slashed its dividend, etc., and the stock price tanked like 40 or 50% thereafter. But it's because they're over leveraged in commercial real estate. So what is going on in commercial real estate that could actually be one of the causes of an economic downturn? Well, first of all, commercial real estate among regional banks, they are over levered. So commercial real estate makes up more than 40% of some lenders' loan books. And that is because here's the crazy thing, right? It's almost like 2008 all over again. But it's because commercial real estate loans account for 28.7% of assets at small banks compared to just 6.5% at bigger lenders, right? Basically, what had happened was the requirements for taking on commercial real estate loans were too stringent at big banks. And so small banks, because they wanted to pile up loans on their books, right, ignoring the fact that the Fed was raising rates and the turmoil that can cause, really over-levered themselves in commercial real estate because big banks wouldn't. So they thought that they would swoop in and take the opportunity. But now they pose a $1 trillion risk because what happens when the Fed raises rates? Well, let's just draw it out real quick. So let's say that you have, these are buildings. I don't know why I'm drawing them like this. Maybe I should draw them like this. But let's just say that these are all buildings here, right? This is all commercial real estate. So obviously during the pandemic when the rates were very low, everything was fine and dandy. But now that the Fed funds rate, let's say, is around 5.25%, and these loans are super high. Well, when these businesses here have to refinance because, people think that commercial real estate is like a home loan where the mortgage is 30 years. No, they're much shorter terms, very, very short terms. So they are forced to refinance during the middle of their tenancy, right? So when they refinance, they have to refinance at higher rates. Obviously, their payments go up. But also what happens when the Fed raises rates? That tends to put pressure on businesses' ability to spend money. It puts pressure on consumers' ability to spend money, that thereby these businesses actually make less money, right? And you start to see defaults because they cannot afford these loans. Now, what makes matters worse is because there are now an increased number of vacancies in commercial real estate, right? Because to jump into an office is so expensive. There's a huge number of vacancies. The property value of these buildings. So even if you foreclose and the banks have to take the property and sell it, they are going to be selling these properties at a loss, not even enough to cover the loans that are taken out. Right? So that is why raising rates is such a blunt tool. And this is just one example using commercial real estate. But this is where I think there will be a crack in the system if the Fed is forced to keep rates higher than expected. So in summary, I'm going to start hedging here. Like I really am. I'm not a doom and gloomer. I actually told you that I think the S&P 500 will hit 5,000. We're well above 5,000, right? I'm not a doom and gloomer. I do think the stock market can have some juice left, especially if CPI comes in, below 3%. I do think the stock market can rally. I think there can even be a rotation into other sectors of the S&P 500. But I do think it's now just a game of chicken between something breaking in the economy, between a recession, which I think is going to come once the yield curve uninverts, once the Fed is forced to cut, and the stock market, right? Like I'm not excited to buy the S&P here. I'm not excited to buy the NASDAQ here. I'm not excited to buy the Mag 7 here. There are a few things that I am okay buying, right? Some stocks that I like that I think are undervalued, but I'm going to be doing quite a bit of hedging here, especially stocks that I bought really cheap, right? I might not want to sell them, but I might be doing some hedging here. Now, a lot of times I'll see in the comment section, people will say, oh, thanks for telling me, buying puts. Look, not buying stocks does not mean automatically buying puts. Yes, there will be a time when buying puts makes sense, but don't take the fact that just because it's not an opportune time to buy stocks, don't, mistake that with, oh, this is a license to buy puts because I'm not bullish. No, being bearish and not being bullish are two different things, right? So I don't know that I would short the stock market here heavy beyond hedges. One thing I am interested in for sure are VIX calls. That is for sure. Maybe this is for another video, but I am definitely interested in VIX calls here. And part of the reason is because things are starting to look like what happened with Volmageddon in February 2018, where the VIX literally jumped 40 points or something in the span of 2 days. But basically, there was a lot of complacency and a lot of short volume on the indices, right? And I think short volatility on the indices. And we are nearing that same sort of vol crush here. Now, I don't want to get so much into the mechanics of this. Maybe I'll do another video on it if you guys want. But for this reason, as well as the fact that I think once the volatility starts getting to historic lows, I do think that buying VIX calls as a hedge is sometimes much better than shorting the stock market. Anyway, let me know if you want a more detailed video on that. I would be happy to release that for you guys if you guys want. But that is my take on it currently. That is my take on the fact that the S&P 500 is at historic lows if you remove the tech stocks, and what I think is going to happen with regards to a rotation into some of these beaten down stocks in the S&P 500 until something starts breaking and the Fed is forced to cut. So I do think that the rally can continue for a few more months. Not going to lie and say that I'm excited to buy a lot of things here, but that's where I'm at. And my opinions can change with new data, right? So let me know if you got something out of this video. Let me know if you agree in the comment section below. Let me know if you're buying something. Let me know if you're shorting. Let me know if you're just sitting in cash. Let me know your thoughts. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.